This video is going to be an extremely detailed video on how Index Universal Life policies work. In this video, I'm going to be talking about how the loans work, the different costs and fees of the policy, the different types of designs when it comes to Index Universal Life policies and what makes them different from any other kind of form of life insurance, and much more. So if you really want to understand how these policies work, make sure you watch all the way until the end of this video because you're going to get a lot of good information from this. For those of you tuning into my content for the first time, my name is Pascal and I work with Thrive Wealth Solutions, and essentially we help people have the time to reach their financial goals by using simple private banking strategies. If you want to learn more about that, I'll link a video at the end that you can watch that explains that concept in detail. But for today, we're going to be talking about how an Index Universal Life policy works in detail. The first thing I want to start off with is the difference between term and permanent life insurance. So term insurance is when you put your money in a policy and you get basically a death benefit only. You have a term for either 10, 20, 30 years. And basically it's just for the peace of mind for that time period. If you don't have a lot of money, you get a term insurance policy because you could get pretty cheap term insurance policies, especially if you're young. If you're 25, 30, you could get a $300,000 death benefit somewhere around $20 to $35. So it's not a lot of money when you're putting money into a term insurance policy. But the thing is, when you get a term, essentially there's no cash value built up and it basically expires at the end of it, and basically all of your money doesn't have any other benefit for you other than giving you that protection for that period of time. It gives you some time to build up your network, build up your assets so you can invest into different types of asset classes or eventually get into, say, a permanent policy sometime in the future, but it gives you that temporary protection at a lower premium. There's also permanent insurance, where some of it goes into the cost and fees of the insurance, and then another part of it goes into the cash value component, where basically you could use that money, grow that money, and potentially access that money depending on how your life insurance policy was structured. There's a variety of different types of permanent policies. There's whole life, there's universal life, there's index universal life, there's variable universal life. So what makes an index universal life or universal life in general different from a whole life insurance policy? A whole life insurance policy has a guaranteed death benefit, basically meaning if you have, say, a 10-pay or 20-pay whole life insurance policy, you have that basically that death benefit guaranteed for life, considering that you don't have any outstanding loans or anything like that that are paid off, and those are typically get deducted from your death benefits. With universal life insurance policies, for the most part, it's a non-guaranteed death benefit, which basically means if you have sufficient cash value in your policy, you're going to be able to keep that death benefit throughout your entire life. And this is what gives the universal life potential in terms of more advantageous benefits when it comes to cash accumulation in whole life, is because it does not have a guaranteed death benefit. Because if your priority is to accumulate money and accumulate your cash value, you don't want a guaranteed death benefit. Because when it comes to universal life insurance, it's something known as annual renewable term. So basically what you're doing is you're getting this insurance policy, this permanent insurance policy, where every single year you have an annual renewable term, which means the cost per unit technically gets higher every single year. But at the same time, you're taking advantage of a discount because if you think about a term insurance policy that's annually renewable, the cost of insurance is going to be very low in the beginning. So if you're using a strategy of wanting to self-insure yourself when it comes to using a permanent policy, and if you want to maximize it for cash accumulation, that's what you want to do, you're taking advantage of the low cost of insurance now. And basically, if you're self-insuring, meaning let's say you have a $500,000 death benefit and you have a $30,000 premium, for example, that you're putting into this policy every single year, the cost of insurance is going to get lower because the amount of units that the insurance company is insuring you for are also going to get lower. Because the next year you're going to put a $30,000 premium into the policy, and considering you have a level death benefit, meaning the death benefit doesn't increase, the next $30,000 is going to self-insure you for that $500,000 death benefit. So if you want to think about that death benefit you currently have, what you're getting charged on is something known as the net amount at risk to the insurance company. So if you put a $30,000 premium and you have a $500,000 death benefit, now the insurance company is only charging you for $470,000. And then you put another premium, now the insurance company is only charging you for $440,000, and so on and so on. The overall amount of insurance that you're getting covered for, or the insurance company is charging for, are going to drop because you're using a strategy of self-insuring, and that's what you want to do when you want to maximize the cash component of it. And that also goes with two ways when it comes to structuring an index universal life policy, which is there are two typical ways you could use your death benefit. There is an increasing death benefit and there's a level death benefit. So the benefit of using an increasing death benefit is, let's say you're using insurance as a retirement plan, like the LIRP, they like to call it. So what people do to maximize what it is an LIRP is they'll use an index universal life policy with an increasing death benefit. And basically what it allows them to do is qualify for the lowest amount of insurance possible for the life of the policy. But they're not going to basically be able to take out loans early when they structure it like that. The purpose of structuring a policy like that is after 10, 15 years of funding a policy, then you're going to be able to take out income. The other alternative when it comes to index universal life policies is using it as a level death benefit, which essentially means you're self-insuring right away. Like I was talking about before, you have a $500,000 death benefit and you have a $30,000 premium. And you keep putting that $30,000 premium every single year into the policy. But the benefit is your cost of insurance is getting lower. Considering that your cash value life insurance policy has a lot of liquidity, you could use that money right away without increasing your cost of insurance when you're using a level death benefit. And that's why if you're structuring it more like a bank account, it makes more sense to use a level death benefit than an increasing death benefit. And ironically, you're actually going to be able to save more money in the policy if you use it as a bank account versus using it as a retirement plan, because this is money that you'd already be spending anyways. But I'm not going to go too deep into that. If you want to learn more on how to structure it in that way, I'll link a video at the end that you can watch in detail. But in this video, I just want to specifically talk about the features when it comes to index universal life policy. And that is the upper and lower limits when it comes to funding your insurance policy. So what you want to do is take advantage of the IRS tax code to the extent they allow you to take advantage of it up. So what you want is you want to put as much premium dollars that you could put in with the lowest cost of insurance. Even though you can't completely eliminate your cost of insurance, you can still take advantage of the tax codes or the provisions that the IRS allow you to take advantage of. And essentially what you have is the least cost and the most amount of premium you could put in, so you could have a lot of liquidity and a lot of growth in your policy. What most people do, which is a big mistake, is they put the least amount of cash they could put in with the most amount of insurance, which basically means there's no cash value buildup. Most of the money is going to go to costs of insurance and fees, which is not what you want when you want to have a permanent cash value life insurance policy when you're trying to prioritize accumulation. So you want to take advantage of the tax code as much as you possibly can when it comes to getting a permanent life insurance contract. To go into deeper explanation on how your index universal life policy works is the way your policy is credited. So let's say, for example, you put a $30,000 premium into your life insurance policy. What the insurance company is going to do if you have a universal life policy, an index universal life policy, is they're not going to directly take that money and buy that point-to-point options that you know about when it comes to index universal life. What they're going to do is they're going to take that $30,000, they're going to put it into some sort of fixed account earning around 3 to 4%. So say, for example, the insurance company earned 4% on the $30,000, so that's $1,200. Then they're going to use that $1,200 they generated essentially for free to put that money into yearly point-to-point options, something like the S&P 500. And they'll credit your account based on the performance of those options. So typically you'll see something of an index universal life policy having something like a 10% cap and a 0% floor. So if the stock market goes up, the S&P 500 goes up 20%, you're capped at 10. But if it goes below 20%, you have a guaranteed floor of 0. This is how your money is not subject to market risk when it comes to index universal life policies. And another very important feature when it comes to index universal life policies is the loan feature. So there's two general types of loans that you can take out that I'm going to explain in this video. There's a few others that are more specific, but I'm just going to say two just to keep it simple. There's a participating loan and there's a wash loan. So a participating loan is basically when you borrow money from the insurance policy and your money is still participating in the same indexes that you have your money in. It's not actually getting switched. Your indexes aren't getting switched. So you might borrow at a cost of say like 4% and keep your money in a S&P point-to-point strategy where it could earn anywhere between 0 to 10% depending how the S&P 500 performs. And that's what would be considered a participating loan, is that you're just taking advantage of the two different markets. So you earn around like 5 to 7% from point-to-point strategy. and you're getting charged around 3 to 4% from the loan. And there's also a wash loan where you can essentially borrow from the insurance company at a rate of 3% and they'll credit your account 3%. So essentially it's washed and there's no cost. So there's no arbitrage potential built into it. You're just basically getting credited 3% and getting charged 3%. So it's like similar to a withdrawal, but it's not considered actually a withdrawal. This would be a loan feature that you would have no income potential in making money from taking a loan. The other one is where there is some income potential when you take money from a loan. So technically when you do take loans, you are technically taking risk, but at the same time, as long as you're not over leveraging, you're fine when it comes to using index universal life policies, because you have to understand there's a difference between good debt and bad debt. So bad debt would be like consumer items. You buy things that have no chance of going up in value. Good debt would be considered loans that have a chance for you to make money. That would be like loans that you're getting from, say, an insurance policy, or loans that you're using to buy things like real estate properties. Those are considered good debt because you could actually make money off of them. So it's only bad if you over leverage it. Meaning, say for the first year, let's say you paid 30 grand, put 30 grand of premium in your policy, and you borrowed 30 grand of premium in your policy. Now there's no money to cover the costs and fees of the policy, and your policy could lapse when you do that. That's why at Thrive, what we recommend clients to do is basically save at least 20% if you have a highly liquid cash value policy, and you could leverage out 80% of whatever you put into it in its premium to pay for bills, expenses, and investments. Because at least for the first 7 years, you want to follow the IRS guidelines in terms of something known as the 7-pay test, which basically is what the IRS watches for to make sure you're not overfunding your insurance policy. And save in the policy for at least 7 years, and then you could leverage out whatever you put in the 8th year. You don't want to do that right away. You want to make sure you do save some discretionary in the policy to make sure you have sufficient money in it to take care of the costs and fees of the policy. And that goes into my next point. What are the costs and fees of an insurance policy or index universal life policy? The first cost is the thing that everyone knows of, the cost of insurance. So, like I said, if you want to maximize it for cash accumulation, you want the least amount of insurance and the most amount of premium. The thing is, when you talk to a lot of advisors and agents, sometimes they'll go to advisor agent and say, I want $500,000 worth of death benefit, or I want $1 million worth of death benefit. The problem with that is you might not be making your policy cash efficient, because most of your money might be going to costs and fees and commissions, which is not what you really want if you're trying to maximize the cash accumulation benefit. What you want to do is you want to get the lowest cost policy and put as much money as you can so you could have the liquidity and cash accumulation benefits of an index universal life policy. Second is the surrender charge. So the surrender charge is a charge only if you surrender the policy. This is basically how an insurance agent or advisor would get paid to some extent. And also, this is how the insurance company is able to make some sort of money from the policy, because if you put in 30 grand and you borrow the entire 30 grand, the insurance company never really has a chance to make money. So they want you to keep a certain amount of money in the policy for a certain amount of years. Generally, all surrender charges drop completely after year 10 when it comes to index universal life policies. Somewhere around 10 to 15 years, you no longer have any surrender charges. But this money is still accumulating for you. You're just not going to be able to withdraw it or borrow from it when you have that policy set up within the first year. But your liquidity increases every single year and the surrender charges drop every single year until they eventually become zero. So it's just a way that the insurance company somewhat restricts you in terms of taking out all the premium dollars that you put in, so they could use that money to invest and grow their insurance company. Because if everyone just put in $30,000 for premium and borrowed $30,000 right away, essentially the insurance company is not going to have a chance to make money. And lastly, there is the premium expense charge. This is a charge that when you put in premium, the insurance company charges you somewhere around 4 to 8% of the premium. And essentially what it is, it goes to a state guaranteed fund. So in case the insurance company goes belly up, the rare case that a mutually owned insurance company goes belly up, there are still funds to take care of some of those claims and death benefit claims that people are going to have in the future. So it's just added security and safeguards that's required to basically make sure that if there are many death claims or the insurance company needs more money, those claims can still get paid. Here's a quick picture of how much liquidity you could have in the first year. As you can see, you can have over 80% access the first year of your insurance policy, and this is mine in particular that I currently have. and I could use that money, borrow it to invest into business endeavors, pay for expenses, or anything that I really need. Because at the end of the day, this could either be the best thing you own or the worst thing you own, considering the way it's structured. So you want to make sure you do it right the first time so you don't have to do it again. And different types of insurance companies have different types of provisions. Like some of them have long-term care riders where if you get sick or disabled, you'll be able to use that money while you're still alive to take care of medical expenses. There's different types of income for life riders, liquidity riders, and all those different types of features that you can use for a certain policy. And depending on what type of advantages you want in your insurance policy, there are some different types of provisions that you could use as add-ons to improve your policy and use it to your benefit. So I hope you guys found some value in this video. If you like content like this, make sure you like, comment, and subscribe, or ask me any questions that you want and leave them in the comments below and I will get back to you. So hopefully you guys enjoyed the video and have a good one.